Kenya's economy in the second quarter of 2025 is increasingly defined by a significant labor market burden amid modest growth, raising the question of whether the country is facing a period of unemployment drag rather than a sustained expansion. The headline GDP annual growth rate in Kenya is around 4.9% year-on-year in early 2025, slightly down from circa 5.6% in 2023 and 5.7% in 2024. This growth rate, while positive, is modest for a country with Kenya's labor force growth and employment needs. It suggests growth is unlikely to generate sufficient new jobs to prevent unemployment pressures from increasing. The unemployment rate in Kenya stood at approximately 5.4% in 2024, down from 5.6% in 2023, yet official figures may understate deeper underemployment and youth joblessness. For Q2 2025, the rate is likely around that same level or slightly higher since job creation remains under strain. The labor market challenge is that even with growth near 5%, the rapid expansion of the labor force and structural shifts mean many entrants struggle to find formal employment. On monetary policy, the interest rate, central bank policy rate in Kenya is roughly 9.25% in 2024, slightly down from around 9.5% earlier. These rates reflect attempts to stabilize inflation and the currency, but high borrowing costs for firms and households dampen credit growth, investment and job creation. The inflation rate is around 4.6% in 2024, indicating moderate price pressures but still sufficient to erode real incomes for lower-wage workers and constrain consumption-driven employment. The debt-to-GDP ratio in Kenya in 2024 is estimated at about 65.5% and is projected to reach approximately 68.0% by end 2025. That debt level, combined with growth and labor market stress, raises concerns about Kenya's capacity to stimulate job creation via fiscal policy. Together, these metrics portray a Kenyan economy in Q2 where unemployment is a central concern amid moderate growth, elevated borrowing costs, and significant debt. Delving deeper, growth near 4.9% is respectable on a global basis, yet in Kenya's context, the labor force growth and need for formal employment mean it is insufficient to reduce unemployment meaningfully. The Q2 environment shows that labor markets are not keeping pace. Job creation is weaker than in past stronger growth cycles, and many sectors are experiencing slow hiring or job stagnation. Youth unemployment, discouraged labor, underemployment in informal sectors and regional mismatches mean the cited 5.4% statistic likely masks more serious employment pressures. Formal employment growth is moderate, and productivity improvements rather than headcount increases may account for much of the output growth. This dynamic constrains the ability of growth to translate into employment and thus suppresses the jobs-rich nature of growth needed for structural progress. High interest rates around 9.25% limit the expansion of credit to small and medium enterprises, which traditionally are job creators. Firms facing high cost of capital delay expansion or hiring. Likewise, households facing elevated borrowing costs reduce consumption and investment in small enterprise. These financing conditions in Q2 reduce firms' hiring incentives, amplifying unemployment risks. The moderate inflation of 4.6% further complicates the picture. While not extreme, inflation still erodes real wages and purchasing power, particularly for those newly employed or in the informal sector, thereby suppressing consumption demand and weakening job-rich growth. Real income growth is muted, reducing job creation downstream in services and retail. To summarize, moderate growth, high interest rates, moderate inflation and rising debt create a labor market environment in Q2 with high unemployment risk. Kenya's debt-to-GDP ratio of 65.5% is significant. This borrowing, used to finance infrastructure and recovery, has raised the debt burden, constraining fiscal policy. As a result, the government's capacity for large-scale job creation is limited. Sectorally, Q2 displays weak employment growth in agriculture, manufacturing, and construction. Services employment is also slowing, and youth entering the labor market often find themselves in informal or underemployed roles. Policy responses are also limited. The central bank's interest rate, around 9.25%, restricts easing without risking inflation. In short, the Q2 data paints a challenging picture. Growth at 4.9%, unemployment around 5.4%, and rising debt. This combination means the labor market is under significant strain. Growth is positive, but insufficient to absorb the expanding workforce, while high borrowing costs limit job-creating investment. The result is high unemployment persisting even in a growth environment. In Q2 2025, Kenya's economy faces a significant labor market burden amid modest growth, raising the question of unemployment drag versus sustained expansion. Agriculture mechanization, slowing services, and high youth unemployment mean job creation is not keeping pace. While headline GDP growth is around 4.9%, several factors constrain employment. High interest rates near 9.25% dampen investment, while 4.6% inflation erodes real incomes. Meanwhile, public debt is rising towards 68% of GDP, limiting fiscal options. Together, these metrics show why the official 5.4% unemployment rate likely masks deeper labor market stress. This growth-employment disconnect means the high unemployment rate is not a short-run aberration, but a symptom of a structural challenge. From a forward-looking viewpoint, unless growth accelerates meaningfully above 6% and investment expands, Kenya faces the risk that unemployment climbs further or remains stuck at elevated levels. With debt rising towards 68% of GDP and borrowing costs high, policy space for counter-cyclical job stimulus is narrow. Similarly, if youth unemployment and regional joblessness widen, social and economic costs increase, and the structural challenge becomes entrenched. Q2 thus may mark a turning point where Kenya's unemployment rate becomes more persistent. The challenge is to translate even moderate growth into broad-based job creation, but the conditions in Q2, moderate growth, high interest cost, rising debt, are unfavorable for that translation. In short, the Kenya economy Q2, high unemployment rate narrative captures an economy growing at about 4.9%, unemployment around 5.4%, but likely masking deeper slack. Interest rates around 9.25%, inflation near 4.6%, and debt to GDP about 65.5%. The combination of these conditions means the labor market is under significant strain in Q2. Growth is positive but insufficient to absorb workforce expansion. Borrowing costs remain high, limiting job-creating investment. Fiscal space is squeezed by rising debt, constraining government responses, and inflation and real income pressure suppress consumption and employment creation. The result is high unemployment persisting even in a growth environment. Kenya's Q2 experience is therefore a cautionary tale. Growth alone does not eliminate unemployment when job creation and labor market absorption are weak, and when debt and interest burdens weigh on both public and private sectors. Without accelerated structural reform, investment, skills development, and job-rich growth, Q2 may mark not a rebound but a deepening of labor market slack. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.